So I was speaking to my relationship manager at Lloyd's today about a finance we've got going through, and I asked him about their lending, what they're doing with in Lloyd's, and how the last month or so has affected the margins they charge and the interest rates they're charging on both fixed rate and variable, as well as try to get as much information as I could out of him about the thoughts of Lloyd's going forward into 2024. And the words that came out of his mouth today were, without a doubt, the government is going to be putting as much pressure as possible on the Bank of England over the next few months to start getting rates down in the run-up for this election. So that is definitely the thought of the bankers over in Lloyd's. If you have been watching the last couple of lives we put out, we've been talking about what is going to change in the economic policy, interest rate policy, and therefore the housing market over the next 6 to 9 months in what is effectively the election run-up. Okay, we are now 2024 going into the election cycle. Without a doubt, the election will be called this. Well, not without a doubt, it could be done, right at the end of the period in Jan 25. But I believe it'll probably be sort of Q3, maybe end of the summer this year. So a very good evening to everybody. If you can hear me and see me, please give me a thumbs up and please type something in. I can see Dale and Lek have already typed something in, so that is fantastic. I apologise that this is going to be a bit quick and dirty this evening. I've been absolutely manic since coming back after New Year. The diary has been absolutely chock-a-block. We've got so many things going on with various property transactions and business transactions. It's all very exciting, but obviously takes a lot of time away from what we're doing here on the YouTube channel. Anyway, we want to keep going. We need to keep putting the message out. So today what I want to do is look at interest rates. Interest rates, are they being slashed? Why are they being slashed? And what effect is this going to have over the next 6 to 12 months on the UK property market? For those of you who are new to the channel, a very big welcome to you. Please hit a subscribe if you are new to the channel and you want to find out more about property market, economy, where we're going this year, and understand the data behind the headlines or underneath the headlines to make better decisions. And look, if you're a regular viewer and you are not subscribed yet, please do help me out and subscribe. I'm not going to play the little VT today, but I am going to say that the point of having this channel is to help people make better decisions, and the more people we can reach, the more people can hear the message of what's actually going on, the better we can help people around the UK with their investment and their home buying decisions. So because I'm a bit behind the drag curve, I've even got some notes set out today, and I want to talk first and foremost about the interest rates being slashed. Now, this is not by the Bank of England, sadly. Apologies for the slight clickbaity on the thumbnail. It is the mortgage lenders. 2nd of January have come out and started to slash. That was yesterday, obviously. It's the 3rd of January today. So today, HSBC reported as the latest lender to cut, but this whole stack of dominoes started falling yesterday with the Halifax. That's an interesting ad coming up on there. The Halifax slashing rates, but I think it was 0.95% on some of their mortgages yesterday, which is a massive drop. Of course, the skeptics have said that, 2nd of January, it means everybody who's refinanced on the 1st of January are going to miss that. So they kind of avoided some of it, but they've got the big headline grabbers. And if I'm honest, they were probably sitting at the higher end anyway. So we are seeing effectively an interest rate war starting from the lenders. But what does this mean? Why are they doing it? Is it because we're now dead set on Bank of England base rate coming down? Or is it for other reasons, right? For example, is it because the mortgage market is still pretty frozen and the lenders are really having to fight for competition? Let's look at some of the data and the stats on that. Before we do, I just want to look at where we are in terms of average mortgage rates on this graph we have here. And I've got selected, these lines are both 85% 5-year, 2-year, and 60% loan to value 5-year and 2-year. You can see that we have had, a fairly dramatic drop off since the peak, which was summer last year, and there's been a fairly steady decline on, this is mortgage interest rates, of course, not this is not Bank of England, this is not treasuries, this is, or gilts, this is mortgages. You can see, even though we've had the headline grabbing massive cuts, and this probably hasn't fed in yet hugely, but we are starting to see a shallow off of these rate adjustments. And so don't forget, right, really important thing, and this is why we always talk about, let's get through the headlines. Just because one bank does one product or slashes the rate from one product by 0.95% does not suddenly mean the entire mortgage market, right, is dropping by that much and it's becoming that much more affordable. Like anything, any company, they need to make money, they need to get headlines, they need to get people in, and you'll often have loss leaders to bring customers in or get eyes on your services, whilst other products might actually be going up. You might have more expensive fees, and I've not looked at any of the fees on these as I've just not had time in the last couple of days. So we need to understand not just one-off mortgage with one provider, we need to understand the averages. And when we look at the averages, for me, that shows a distinct leveling off over the last month or so in terms of mortgage rates. And that's because regardless of perception, regardless of when we think that Bank of England base rate is going to start coming down, until it does start coming down, there's only so much mortgage interest rates can come down. Okay, there's always going to be a bottoming or a shallowing. What are we here? We're down at 5-year fixed, 6% loan to value, 4.44% as an average. We can't just suddenly go down to 3.5, 3, 2.5, when Bank of England base rate is still 5.25, because the whole point about the average is this is where the market thinks it's going to be over the next 5 years. So we have seen a shallowing off. So just be careful about those sensationalist headlines that we're seeing. In fact, let's actually look at the swap rates. Okay, so if we look at the swap rates today, current swap rate for a 5-year fix is 3.419. Okay, 3.4. 29th of December is 3.347. So what does that mean? It means the swap rate is actually slightly higher now than it was a week ago, or 29th of December. I know I've just taken it off so you can't see it. In fact, let's just flick it back on. You can see it came down a lot from the beginning of December, but I can remember, I think the lowest I've saw the 5-year swap was 3.2. So we've actually tweaked up a little bit. So even though we've got the headlines of interest rates being slashed, the swap rate has crept up over the last week. Why would a swap rate creep up? Ultimately, okay, the swap rate is the markets effectively, hedging or borrowing to each other of what their perceived costs are going to be over the next whatever the term is. So the 5-year swap rate is over the next 5 years. So it's raised up. So actually, over the last few days, the market believes or has pulled back a little bit, not a lot, but a little bit in terms of that base rate or that long-term rate change. So why would they think that? Why would that pull back? We'll look at a few things. We'll look at inflation today in this. We'll look at some events and geopolitical events, which without a doubt are going to feed into this, right? But first of all, why do we have all these headlines for mortgages? Again, let's just go another level down. Understand why the mortgage companies are competing for business and why they need to get those interest rates down to try and get people lent or borrowing from them. This is the graph of UK Kingdom. You can tell it's been a long day. You can tell it's been a long week. United Kingdom mortgage approval rates. And even though we've had a little uptick, this was December. I think that's actually October's figure. If I'm honest, we're waiting for November's. You can still see how historically low lending is. Now, this is affecting banks. Banks are private institutions. Banks need to make money, okay? And if their lending is low, they're not getting money out the door, then they're not making margin on that money. I would suspect the other thing is if the swap rate's coming down, and sort of gilt's coming down or all of that sort of stuff, saving rates are going to start hurting them as well. So if people are locked into larger, longer term fixed rate savings, and the interest rates, the swap rates starting to come down, that's going to affect saving rates as well. So kind of the inverse of what happened when they were going up. Okay, so banks need to bring business in. They need to make money. Okay, and we're still a long way. The market, even though we're seeing some signs of the property market thawing out, we are still a long way away, from a big unfreeze and transaction volumes getting anywhere near to a historical 5-year trailing average. So that's the first thing to mention, right? So yes, headlines are interest rates being slashed. Yes, some products have come down. Swap rate is not falling down dramatically at the moment, okay? And I'd imagine this is a new year headline grab that has come strategically on the 2nd of January. So after a lot of people have kind of rolled on to the products on the 1st of January, let's get some good headline grabbing in the market to get some eyeballs on and get some customers over, is my gut feeling. The problem with this is, okay, and by the way, I can see all the comments coming in. Let me just go through the various items we've got to talk about today, and then I'll go through and answer any comments from everybody. So please do put your comments in. The issue with headline grabbing narratives like this is the majority of the masses, people who just are browsing media, will go in, they'll see these headlines, they go, interest rates are crashing down, let's go in and start buying, right? Without understanding the fundamentals of what's going in on the market. They go, right, there's so much more affordable. Affordability is solved. We've got strong wage growth, interest rates coming down. Let's go in and buy. Without understanding, right, that we're not there yet. There's still potentially, correction to come in the market, and people could be going in at the wrong time, overpaying and ending up in negative equity if we do see a capitulation of the property market in 2024. So that is something to be very aware of. And to kind of prove this and prove the point, let's look at the Bank of England Financial Stability Report from December last year. So this is only last month's, right? This is last month's stability report. And I understand that December saw quite a massive change in swap rates, almost a 4% drop. But don't forget, swap rates, that does not mean that this is exactly what's going to happen over the next 5 years. Because the swap rate now is 3 point whatever percent, or what is it? What was the swap rate? It was, for the 5 year, 3.419. Because the swap rate is 3.419% now, does not mean set in stone that's going to be the average over the next 5 years. That's just where lenders, banks are lending to each other, institutions are lending to each other and locking it in at that rate. It does not mean that's where it's going to sit for the next 5 years. So if we look at the Bank of England Financial Stability Report and we go into effectively household financial stability, we still see a large aggregate increase in mortgage payments for UK householders. Okay, so this chart here shows number of owner-occupier mortgages increasing between now and end of 2026. Okay, so the orange is by the end of this year, 2024. The blue, light blue, is by the end of 2026. These are the number. So this is in thousands. So 1,000 thousands is a million. Okay, and this is the amount of increase. So we see quite a large increase actually here in the sort of £500 to £749 a month mark, right? This is, what's that, 4, 5, that's 500,000 people will be paying an extra £500 to £750 a month, right, by the end of 2026. So we have to zoom out and look at the aggregate debt service ratio in the UK to understand, if we're looking and talking about macroeconomics, right, if we're talking about average UK house prices, we have to understand average UK debt serviceability ratio. Now, I do caveat this by saying that it has reduced over the since the previous bank financial stability report, which is I think it's a quarterly, I can't remember if it's quarterly or 6 monthly, but the previous one, and this is the historic DSR, debt service ratio. This is where we are kind of here. Okay, when we went into big bubble and then crash of 07, 08, you can see we were up at about 10% in, this is UK aggregate debt service ratio. We are well below that right now, okay? And something that is definitely propping the UK property market up is the much more rigorous stress testing that came in after the financial crisis of 2007, 2008. So actually it's done what it's meant to do. And it's not caused the whole thing to falter or fall over like a deck of cards. But we can still see that over the next 2 years, 24, 3 years, 24, 25, 26, that debt service ratio is still growing. And whilst everybody's getting carried away with, mortgage rates are coming down, Bank of England base rate is going to come down, mortgages are going to get more affordable, we completely forget in the mainstream media narrative that in this year alone, 1.6 million people are going to come off cheap fixed rate debt mortgages. So I call this the gap, right? I've been talking about it for 8 months. The gap is widening. There's more people coming off cheap fixed rate debt. If you're on a 2.5% mortgage product, and you're going up to, what were the averages now? Let's say you're going onto it right now. Let's say you've got 60% loan to value and you're going on to a 5-year fixed rate of 4.44. You're still going to be doubling your interest rate. Yes, it's a lot less than it was, which was, potentially up here, where was it? We were at, sort of nudging 6%. So it's come down from 5.9 on average to 4.44, which is, 1.5%. But it's still going up 2% to where it was. So it's going up huge amounts, just not as much as it was 6 months ago, okay? And when you look macroeconomically, that will almost inevitably, I've not put the graph on, I apologize about that, put the graph back on. When we look macroeconomically, that will have an impact, on affordability. So I think that's worth noting, that we still have lots of people with this delayed lag in the system coming off cheap fixed rate debt. So that's the first thing I wanted to talk about is let's not get carried away with interest rate reductions because we're still seeing the lag effect of people coming off cheap fixed rate debt onto much higher debt. So that's the first thing. The second thing I wanted to talk about is let's just hypothetically, right, say interest rates are coming down. So we've got strong wage growth still, although it's probably peaked and it's on its way down. And interest rates will probably come down, but we'll talk about why, for what reason in a second. Does that mean we've suddenly solved the affordability crisis? And is inflation really, really gone? Or are there gremlins in the system? Now, something that the mainstream media is really not talking about that much. And when I say when I say mainstream media, I mean sort of headlines. So when I browse through headlines on on my phone, on news websites, I'm looking at what the big flashing mainstream media headlines are. I had to dig deep to find this, okay, with what's going on in the Red Sea. And I haven't seen a lot of people talking about the sheer volume of shipping that is now diverting out of the Red Sea and going around Africa, and that is adding millions per shipping per ship to the supply chain. You can see here shipping costs have jumped 250%. Right, this is happening now. This has been happening for the last few weeks, and this is going to carry on happening. And I can pretty much assure everybody that this is going to feed into the supply chain, and therefore the costs of many goods and foodstuffs are going to be going up again because of this. So we've talked a lot about geopolitical inputs into the inflation figures, and how this is going to affect stuff. Now, at the moment, it's not impacting things like Brent too much. If we look at the Brent crude graph, we did actually have a spike up. So I say not too much. In December, we've gone from $73 a barrel to 80. So actually, that's 10% increase. It has kind of settled down a little bit. It's not like it's spiked up to where we were in September, and that hasn't really filtered into the ecosystem. But of course, there's potential for that to go up, and the price of Brent will filter into everything. So when we look at inflation, and people are talking about that rapidly dropping inflation, I always think about CPI is one arbitrary figure. I always link it to go, what's the actual impact on people, right? So screw the basket of goods. What do people actually spend their money on? Who are the most vulnerable people who are going to be affected by interest rate rises, by their mortgages going up? Are probably generally going to be younger families who have 3, 4, 5 mouths to feed, 2 cars with petrol and diesel. They've probably got a mortgage, cheap mortgage they took out a few years ago that's coming out. These are the demographics that have the ability to shift the property market. And when you look at what these sort of demographics are spending their money on, it's shelter and it's food. And we know that shelter has, and when we look at the inflation figures, we look at owner-occupier housing cost has been going up dramatically. Food, people going, yeah, food's getting cheaper. Last inflation set, it was still 9% annual inflation. 9% annual inflation after hitting almost 20% annual inflation. This is inflation compounding on inflation, right? When you go and work it out from 2.5, 3 years ago, how much food has gone up, it is a horrific amount of money. Okay, so if we're now going to be putting more into the supply chain in terms of inflation for food, right, without a doubt, that is going to cause more of an impact on affordability. So I think it's something we've got to look for. I can see questions coming in. Stuff says food shouldn't be traveling via the sea. Yeah, fresh food clearly not. But obviously, consumer goods, and there will be imports, there will be foodstuffs. I would imagine that will come. Grain, for example, I'd imagine. Look, I'm not a logistics supply chain expert. I just imagine there'll be plenty of things that would come via the Red Sea. So another thing that I wanted to talk about, which I've seen some people talking about, is minimum wage. Because another potential inflationary aspect that we've got coming in this year is in April, we've got the minimum wage and, in fact, dare I say it, pension and housing benefit going up by, I can't remember the figures off the top of my head, somebody might have to help me, but double-digit increase. I've seen commentators say this is going to be inflationary. So I've been trying to very briefly work out if this is going to be inflationary or not and what the impact is of the base level wages going up. Got a thumbs down for that. I'm pretty sure they are going up. So I'm not sure why there was a thumbs down for saying minimum wage is going up double digit. So as you know, I own a group of scaffolding companies. We have people on minimum wage, we have labourers, we have drivers, and then of course we have various levels of qualification above that, from Part 1 scaffolders to Part 2 to advanced to contract managers. I can, with some certainty, say that minimum wage going up will cause a trigger, a ripple, where everybody's wages are going to have to be up. Because if you're just putting the lowest paid people's wages up by 10%, right, the rest of the workforce is going to expect some form of wage growth as well. So we'll wait to see what happens with this. I have been doing some research on the impact of minimum wages on the economy, and this is from Investopedia. And there is, sorry, that shouldn't be going up like that. Press it. I'm on the wrong screen with my cursor. Effectively, this article says that raising minimum wage shouldn't, in theory, be an inflationary thing. In fact, it's almost the opposite. And in times like this, and everybody go and read this, do your own research. I'd love to have a conversation about this and what your thoughts are, if this is going to be inflationary or not. The general sort of theme that goes through this article in Investopedia is actually raising minimum wage by this sort of amount is going to put a lot of pressure on companies. And so that additional wage burden on companies will actually lead to more redundancies and less headcount, which is, in a time where a lot of companies are hitting a lot of issues anyway, could well be the final thing that pushes them sort of over the line. I couldn't help but see this morning in my newsfeed. Obviously, it's a high-profile chef. Simon Rimmer just closed his business. But effectively, when you read it, he talks about, if I can find the thing, what does he actually say? There you go. I just want to read this. The cost of raw materials, the cost of heat, light and power, employing people and general food costs have meant that the business, unfortunately, has become unviable. So when I look at it into my own company, there does become a point where you cannot just keep raising your prices anymore because people can't afford them. But if you keep raising wages, then it's going to start breaking the company. And I guess one of the concerns we've got is insolvencies this year rising and the effect of the economy faltering anyway. And I suspect what will happen is this could do more damage than good and actually cause damage to businesses, which in turn creates damage to perception, to the economy. That in turn causes issues in the housing market, and that's where things get into this spiral. So I'm not saying that's going to happen. I think it's going to be one of two things. Either it's going to cause inflationary issues, or it's going to cause businesses to creak and go insolvent. Neither of these are good things as far as I'm concerned. So we've got quite a lot of things to unpack there. So just to summarize that, the title of the video was Interest Rates Slashed. And from my point of view, I'm feeling mass media perception. Oh, sorry, there is one more actually, if I can find it. Because this is kind of the point of it. Let me just try and bring up my news and I'll share that in with you, team. Because there's one headline that you're going to love. I want to bring it up. There we go. Here it is. If I open this up and go back in. If we boil all of this down, this is the narrative I'm now starting to see in... Oh, no, you can't. Let me come off big screen so you can see the headline. That's just slightly annoying that I've got it set up like that. There you go. That's the headline, January the 2nd, yesterday, in the Sunday Times. Okay. And for me, this is the perception that the masses start to buy into with the narrative of interest rates coming down. And there's that binary association that interest rates down equals property market going up, right? It's just that simple because all the commentators, including me, talking about when interest rates going up, property market is going to go down. It acts like gravity, right? Interest rates act like gravity on asset prices. That's economic almost certainty, right? So, of course, if you follow that logic, when it comes down again, then that's going to cause house prices to go up. Not as simple as that for various reasons. If I scroll through this, I want to actually find, because there's one particular company that are making these predictions. There we go. I want to highlight this if you can see it. Samuel Toombs, chief UK economist at Pantheon, right, and it's Pantheon again, said that the dynamics in the housing market could lead to a double-digit percentage increase in average house prices this year if buyers were to devote the same amount of mortgage payments as they did in November 2023. Which I find that an incredible prediction to talk about the possibility of double-digit 10% plus property prices this year in 2024. And this is an article that came out yesterday. So remember a couple of days ago when we went live and we talked about false information, misinformation, psyops, everything that's going to be hit. We're going to be hit with from every sort of angle, every dynamic, mainstream media, social media, YouTube, what influencers. When we go into election cycle, I can't help but think I look at things like that and see in the mainstream media, Sunday Times, a prediction of 10% UK house price rise in 2024 because interest rates are coming down. Whereas the reality is, I think interest rates are going to come down because they're going to have to, because the economy is teetering, and the economy teetering, right, is not a good thing for house prices. So to see where we're going to get a 10% nominal house price rise over the next 11 months and 27 days, with interest rates sitting at 5.25% now, I think is interesting, right? So beware of what we read. So that's what I've got for you today. Don't be suckered in by the headlines. I think we need to understand a little bit more about what's going on under the hood there. I'm going to go over to comments very, very quickly because it is 6 o'clock. It is evening. By the way, if that was useful, if you found something in there that that you weren't aware of, or is sort of food for thought, I think the biggest one that I think would be great to have a discussion about, because I genuinely don't know. Right, I was having a conversation with somebody today. We were talking about economics. I am not an economist. By any stretch of the imagination. I've not studied economics. I spend a lot of time looking into it now for the main reason. I do want to share this story with you. As I shared earlier, the reason I do this is I grew my property business from 2010 quite rapidly to sort of 2015, 2016. Then I started doing different types of property deals, sort of 2018 onwards. And everything kind of turned to gold, right? Everything worked really well. And then we went into COVID and we went into lockdown. And the phrase, devil makes, devil makes work of idle hands, or whatever that is, right? Basically, when you're sitting around doing nothing, you make some really dumbass mistakes. And what I did is I took a lot of liquid capital that I had at the time and thought I knew what I was doing, but I didn't know what I was doing. And I got suckered into mainstream herd mentality and put them into some seriously high risky investments and lost a lot of money in 2020. That was 4 years ago. And I made a decision then to focus on the economy, focus on macroeconomics, understand the impact of various things that are happening. So when something like COVID happens, what's actually going to happen? Think it through. When the government prints money, what's actually going to happen? When they tighten money, what's actually going to happen? To have a much better idea of long-term effects of these actions that we see now, so we can have a better idea of where to invest our money, where to put it, where to safeguard it, and where to multiply it when the time is right. So that's why I started this channel and put out commentary and narrative like we do. So I think it's really worthwhile. So if there's anything that we can have a chat about and discuss about, I'd really love to do that, because I do not know how raising minimum wage will affect, if it will be inflationary or not, or will it start creaking businesses. My thoughts are it's going to start creaking certain businesses in certain demographics. And for me, probably the most strongly performing businesses are our services sector, financial services sector, which we're a global hub of, probably don't have a huge amount of people on minimum wage, so it's probably not going to affect them very much. However, construction companies, many of which are on the line, will have a lot of people, a lot of labourers on minimum wage, and that could well tip the wrong sort of companies over. So it's actually going to damage, manufacturing, construction style companies, and maybe that'll just get absorbed, and the data will get absorbed over the financial services side of things, which will skew it, so it won't be entirely mainstream. I don't know. We'll wait and see. So let's have a look at some of the comments. What's up, Rob? Good to see you. Mark. Banks are independent. Rishi doesn't fudge numbers. Just look at the news. Another set is fudged. Are we now saying the banks will fold to Tory pressure? So on that, Mark, when I said when I was speaking to Lloyd's earlier, we were talking about interest rates. He was referring to the Bank of England rather than the banks themselves. I don't think it's the banks folding to pressure, but I think the government clearly is going to be putting a huge amount of pressure on central bank to get those interest rates down, which is why, we've seen the markets be saying, we're coming down. I saw somebody predict six reductions this year in base rate, 6 in 2024. That's some fairly rapid loosening right there, isn't it? And of course, I guess the banks are just following swap rates, which they don't particularly set. But yes, interesting. Right. Stafford says, very good point. Stafford, 12-month delay on lenders pursuing debtors. Those will be interesting figures that filter through. So it usually takes about a month for the arrears and possessions data to come through. People who are regulars on this this channel will know that when it comes out on a quarterly basis, we go through and crunch those numbers. So I'd expect Q4 to probably be out at the beginning of February. For those of you saw Q3, we saw that we were seeing a very definite rise in arrears in residential, not in possessions, clearly, because of the 12-month grace that's being given. But what was very obvious was the buy-to-let sector. From memory, I think it's year on year, 148%, something like that, increase in people getting into the 2.5% to 5% arrears brackets in the buy-to-let sector. That's really being quite decimated right now, and where there's a lot of opportunity. There we go. Excuse me. Mandy, thank you for your comments. So yeah, let's put this on Stafford. So I can see house prices to be best flats. We will have repossessions and sell fast coming up as the renewals bite. Yeah, look, just to clarify my position on where the market's going, I don't think with the current data that we've got, and the integrity of it obviously has to be questioned always. We always need to challenge everything, right? Never believe anything on face value. Always challenge. But with what we're seeing right now, there are still the macro factors that are stopping and precluding a market crash. So I know there's a lot of commentators on the YouTube sphere who are, the market needs to crash. The market's going to crash. The market's going to crash. I'm not saying it won't crash. I just think it's important to have a balanced view on it. I think we could capitulate if the economy really starts tanking, and that's still a possibility. However, the reasons I think that it's not going to crash, and when I say, for me, a crash is double-digit decline in a year, the reason I say it's not going to crash are for these fundamental reasons. Number one, the stress testing by the banks when they issue mortgages. This is a categoric difference between where we are now and 2007, 2008. So the stress testing has been high, but over the last 2 or 3 years, it's been, I think stress testing has been at 9%, something like that. So we're generally lending, or people who are borrowing are able to borrow. Now, of course, this means less people can borrow, which is a reason, with the interest rates being high. Another reason, I don't think anybody's really talking about this, another reason the market is clamping down is because people just can't get the mortgages, right? Because the stress testing is so high. I'm struggling with this, buying a rental property, a development site at the moment, which is one we've had going through for the last sort of 2 or 3 months. And actually, we're struggling to get the finance through because of stress testing and serviceability of the debt. For the main reason that the bank will only stress test it at a certain rent roll, which is, I'm not going to go too much into the details, but we're going to be operating it as a boutique short-term let model. And because it's quite expensive, there's obviously quite a lot of debt we're trying to raise on it. The stress testing doesn't work with the single let rent roll. We're not buying it for single let, right? We're buying it for boutique short-term lets, short-term holiday accommodation. But the bank don't care about that because there's no track record. So this actually makes it much more difficult to borrow. If it's more difficult to borrow, there's going to be less borrowing, and therefore there's going to be less property transactions. We're seeing less property transactions. Another thing that's causing the less property transactions, and so therefore not crashing the market, is the fact you still got all of these millions of people on cheap fixed rate debt. Why would you sell and get rid of that cheap fixed rate debt when we've got much higher interest rate products up there? You're going to stay put unless you have to sell. And because we don't have the criteria for forced sellers right now, people are just not moving because they're holding on to their cheap fixed rate debt that they're locked into rather than sell it. So all of these factors combined together, and plus third, strong nominal wage growth, right? So the fact that we've seen real house prices crash, and we have, right? We're in a inflation adjusted real house price crash territory. We're over at the end of Q3 on that data, and it's something that's published quarterly by Nationwide on their HPI. I think we're at 15% peak to trough already on inflation-adjusted house prices. But nominal are cushioned by the nominal wages, which have been going up very strongly. Of course, now we are in real-time wage growth as well, so that will also prop it up. So these things for me preclude this massive correction. Interest rates coming down and sentiment. I would not be surprised to see Q1 this year see a pop and a boost in house prices and the indices, and just the way the indices work doesn't mean that we can't still get amazing property deals out there, but I wouldn't be surprised if there's a boost. So that is why I don't think we're going to see a capitulation of house prices and a massive crash unless the economy goes first. The economy going first will be the trigger. And of course, as you say, Stafford, there's the 12-month forbearance from the banks anyway. So again, that's drying up the forced sales or the property transactions. Lovely. Rob says, what other property YouTubers do you respect? Oh, it's probably not the forum on a live stream for me to be saying that, Rob. There's lots that I respect. And by the way, I would just like to say this. I respect everybody, right? That's on YouTube. I think when you do YouTube, when you're on YouTube, especially when you do regular YouTube lives, the amount of actual work and preparation that goes into it and creating videos and the consistency of people is phenomenal, right? There are people who put out videos every single day, and I have such utmost respect for people who can do that. I can't do that, which is, by the way, why I go live. It's much easier just to go live than try and record and cut together a sort of 10, 15 minute video. So I actually have respect for everybody who can puts themselves out and shares their story, shares their narrative and their views. And anybody who shares their views, if I agree with their views or not, I respect. I might not agree with their views. I do think there's a habit on YouTube of people going polar to get eyes on, and that's just media, right? Media will always go polarizing to try and get eyes on. So just because I don't agree with their views doesn't mean I don't respect them. I think that might be a bit of a get out of jail free answer for you, Rob, whilst I'm on live stream. Lek says, let me put this on, Lek. I think the next 2 quarters will be a massive rollercoaster due to many things coming together as election in the UK and USA. Yeah, I totally agree, Lek. And we said this last week, that there's going to be some interesting shenanigans going on, because it's not just UK going to elections. Say it's US going to elections. It's something like I read I think it's over 4 billion people this year are going to the elections. So that's pretty much half the world's population is going to elections this year, which is interesting. Look, I think we are chaotic. It is roller coaster right now. There's everything. Property is usually a very sedentary sort of marketplace. Now, I don't know whether it's the social media effect and we just talk about it more, but things seem to be changing very rapidly in terms of swap rates, in terms of interest rates, in terms of perception, in terms of data that's coming out. There's no clear trends and stability. It's all over the place. As I always say, whenever there is uncertainty, whenever there is chaos, right, there is opportunity. So if anybody is looking to invest in 2024, I believe 2023, I did just over £1 million worth of property acquisitions in 2023, and 2024, I believe, are probably going to be the 2 best years we've seen for a long time in certain sectors. Not in traditional buy-to-let, not in vanilla buy-to-let. If you know what you're doing, there are such amazing opportunities. And don't forget, we're part of a cycle. At some point, this cycle will change. And if you are investing in anything that has commercial valuations and you're buying anything with commercial valuations, you are able to buy stuff for pence on the pound right now. And I'm not going to go into valuation methodology and inverse yield relationships and all that sort of stuff. But as interest rates do come down, which they will, yields change, yields drop, values go back up with a commercial valuation methodology. So there is an opportunity. There's an opportunity to accumulate stuff with commercial or assets that we can that are at depressed commercial valuations, which you will see when interest rates change, passive gains as a value add mechanism. If anybody's interested in that, I've not got a link to it here actually, but tomorrow I'm doing my first live training, I think in 5 years, as a webinar, and it's all about how to grow your property business if you're looking to get into property or accelerate or grow a property business in 2024. It's all about how to basically source, secure and structure what I call property unicorns, which are ultra high cash flowing property deals that you can add significant value through multiple mechanisms, but really as passive as possible, generally sort of shuffling paper and sorting out lease issues and stuff like that. What I will do after this is I will put a link to it on the pinned, I'll put a link to it in a comment and pin that so you can come back and register if you want, and there is a link to it in the community. So I hope that answers the question. Oh, sorry, there's one more question. One more question, then we'll go because it's dinner. Lloyd says, if you're considering buying, what areas in the UK would you recommend as safer bets? Lloyd, I'm not sure if you mean residential for you to live in or as an investment. Personally, I don't think it really matters, but it depends on what your strategy is. So generally, I avoid London because it's expensive to get in London and the yields are lower. But gross yield are vaguely irrelevant if you're operating, if you know what you're doing and you know how to add value. Here's the thing, location doesn't matter. I say that with a pinch of salt because clearly if you buy like a holiday, something you want to do as a holiday home and you put it in a power station, right? I mean, maybe you'll get a market for that. But of course, location on a micro level. But in terms of regional, if you know what you're doing, it's irrelevant because as a professional property entrepreneur, you're looking to do two things. You're looking to force value appreciation. You're looking to create cash flow. If you're looking to hold a property, it's different to developing, by the way. If you can force value appreciation 20 to 30%, unless the market suddenly capitulates 20 to 30%, you're always going to be over. You're never going to be underwater. I would find it strange if from here we lose 20 to 30% very rapidly. If we do, as long as you're not breaching loan to value covenants and you're not going to get repossessed, it doesn't actually matter if you're holding it for the long term, right? So if you can force value appreciation and if you can generate a cash flow, regardless of what the interest rates are, and stress test them to 8, 9, 10% and still have high cash flowing income streams, it doesn't matter where you are in the country, you've risk mitigated it as a model. I'm not sure that kind of answers the question. Lex saying the same, struggling for areas. Less about the area, more about the model that you're operating. So of course there is, as I said, there's going to be micro strategies. You're not, as I said, you're not going to be put a massive high-end HMO in an area with no demand for HMOs. But if you can force appreciation, generate cash flow, doesn't matter where you are. I'll leave you with that. If you want to find out more about that, by the way, team, find the link to tomorrow's training. It's at 7:30 tomorrow, Thursday, the 4th of January. And it's not on YouTube. It's private webinar, but it's free. So please come along, and I look forward to seeing you then. Right, I'm going to call it a day there, team, because I need to go and get my dinner. And it's been a long day, and I think I've done 6 hours in front of Zoom today already. So it's been a pleasure. I will see you tomorrow if you're on the training. Otherwise, I'll catch you next week. Have a good one.